Welcome to CoreLogic's update on housing market conditions for October 2018, brought to you by First National Real Estate. The Australian housing market continued to weaken over the month, with national dwelling values falling 0.5% in September, marking 12 months of consistently falling values across CoreLogic's National Hedonic Home Value Index. Dwelling values tracked lower across 5 of the 8 capital cities in September, while 5 of the 7 rest of state regions recorded a fall in values over the month. Since the national index peaked 12 months ago, dwelling values have fallen by 2.7%, hardly a crash, and a slower rate of decline relative to the previous housing market downturn, which ran between June 2010 and February 2012. National dwelling values fell by 3% over the first 12 months of this previous national downturn, before declining 6.5% from peak to trough. While the housing market downturn is well entrenched across Darwin and Perth, where dwelling values remain 22% and 13% lower relative to the 2014 peak, Sydney and Melbourne are now the primary drag on the national housing market's performance. We've seen Sydney dwelling values drop 6.1% over the past 12 months, and Melbourne values are 3.4% lower. Not only are these amongst the largest annual falls across the capital cities, but considering Sydney and Melbourne comprise approximately 60% of the national value of housing, the weak conditions in these cities have a substantial drag-down effect on the overall national housing market performance. Regional markets, where housing values have generally been more resilient to falls than the capital cities, are now showing more challenging conditions. Despite regional Western Australia being the only rest of state region to record a decline in dwelling values over the past 12 months, the September quarter saw values falling across the regional areas of New South Wales, Victoria, Queensland, and in South Australia, as well as regional WA. As housing market conditions have slowed and credit is less available, buyer numbers have thinned out. CoreLogic estimates of settled sales are down 10% year on year nationally, while previously strong markets such as Sydney and Melbourne have seen the number of settled sales fall more substantially, down 19% and 16% respectively. As the market moves through spring, new listing numbers have commenced a seasonal rise. Despite listing numbers starting to wind up, the number of freshly advertised property remains well below previous years, reflecting a deterioration in vendor confidence. Although new listings are lower than previous years, the total number of properties available for sale has been climbing higher, to be 9.5% higher than a year ago across the combined capital cities. The surge in total listing numbers is highest in Sydney and Melbourne, where stock levels are now 22% and 17% higher than a year ago. The lift in total stock levels isn't due to vendors dumping more stock on the market. This trend is simply reflecting a slower rate of absorption. More stock to choose from means buyers are generally more empowered, and vendors are finding properties are taking longer to sell. Capital city dwellings are taking 53 days on average to sell, an increase of 11 days from a year ago. Vendors are having to discount their asking prices by a larger margin as well, with the initial asking price reducing by an average of 6.5% before selling. Melbourne's housing market downturn has gathered some pace over recent months, with dwelling values tracking 2.4% lower over the September quarter. That's the largest decline over the quarter for any capital city, and Melbourne's largest fall over any 3-month period since January 2012. The weak conditions have been mostly confined to high-value properties, with the top quartile of the market down 6.7% over the past 12 months, while property values across the lower quartile of the market are actually up 4.1% over the year. More recently, values have started to trend lower across all the broad valuation bands as Melbourne's downturn becomes more broadly based. The housing market has slowed, virtually in line with heightened levels of regulation across the finance sector and subsequently tighter lending practices and a sharp reduction in investment. With the release of the Royal Banking Commission's interim report, there's a chance that already tight credit conditions could tighten even further. The latest credit aggregates from the Reserve Bank show housing credit growth tracking at the lowest level in almost 5 years, and investor-related credit is growing at the slowest pace on record. If credit conditions tighten further, we can expect housing market activity to follow suit. CoreLogic estimates on national settled sales activity is already down 10% year on year. While credit availability is a key factor in the slowdown, other factors are also dampening housing market conditions. Investors, who still comprise 41% of the value of new mortgage demand, continue to face higher mortgage rates and strict servicing criteria, as well as low rental yields and weak capital gain prospects. Changes to taxation policies related to housing, if we do see a change of government at the next federal election, could also weigh on investor sentiment. Changes to demand-side factors are also evident. Nationally, the rate of net overseas migration was down almost 9% over the 12 months to March 2018. That's detracting from housing demand. The slowdown is being most felt in New South Wales, with a reduction of 13,100 net overseas migrants over the 12-month period. Interstate migration trends are also having an impact on the housing market. In New South Wales, the rate of net interstate migration outflow is the highest since March 2009, and net interstate migration into Victoria has been easing since reaching a peak back in March 2017. The net result of fewer overseas migrants and less interstate migration is the lowest annual rate of population growth in these states since 2015. The primary beneficiary from interstate migration-fueled housing demand is Queensland, where the number of residents moving from other states is at the highest level since 2007. Against a slowdown in housing demand is higher levels of housing supply. A record high number of dwellings are under construction across Victoria and South Australia, while residential construction is only slightly off a record high in New South Wales. With such a substantial pipeline of housing stock in the wings, at a time when credit has become less available, investment and foreign buying activity has fallen materially, and population growth is trending lower, this could create some headwinds for the market. There may be some challenges in absorbing newly built housing stock, especially those dwellings targeted specifically towards investors. While the housing risk profile is heightened, economic conditions remain healthy and mortgage rates are set to remain low into 2020. Labour markets have strengthened with solid jobs growth, unemployment is continuing to trend lower, and underemployment recently reached the lowest level since 2014. If labour market conditions remain firm, we should see wages growth continue to trend higher from a record low base, supporting further improvements in housing affordability and debt reduction. Although mortgage rates edged higher in September, the cost of housing debt remains at levels not seen since the 1960s. Low mortgage rates should help to support housing demand and keep a floor under housing prices. With dwelling values recording modest falls or growth rates slowing, housing affordability is improving, which should see first home buyers become more active in the housing market, helping to offset the reduction in investment activity. As the market moves through spring, we're likely to see heightened stock levels providing more choice for buyers. Buyers are back in the driver's seat with plenty of stock to choose from, little in the way of urgency, and plenty of leverage at the negotiation table. Vendors will need to be realistic about their pricing expectations and ensure they're marketing their property as best as possible to attract the deepest pool of buyers. With so much uncertainty in the marketplace, it's even more important than normal to stay up to date with housing market conditions, as well as the key drivers and challenges impacting on trends. You can access all our latest research and statistics at www.corelogic.com.au.